This program is brought to you by realestate.com.au, Australia's #1 address in property. With more properties for sale than anywhere else, we make it easier.
It's good to have your company here on Business Weekend. Well, the lessons from the 1990s housing markets are quite remarkable. People walked away from their homes and their mortgages as interest rates hit 17%, but it was the double-digit unemployment rate that cruelled families' chances of hanging on to those homes. Today, though, interest rates are rising. So too are home prices. And this is different. Or are today's price rises really a false dawn? Paul Ryan is a senior economist with REA Group and a former Reserve Bank senior analyst, and I spoke with him a little earlier.
In the 1990s, leading into the recession, we saw home prices increased 60% from 1986 to 1989, and then we saw really sharp increases in interest rates. And I think that's where the parallels kind of end. I mean, in Australia, over the past 3 years, we've seen prices up about 30%, so not quite the same run-up. But we haven't seen that big increase in unemployment that we saw in the 1990s.
OK, now we should explain that the 1987 share crash brought a response from the central bank to cut interest rates and the government, and it basically tried to drive up home prices to rescue the economy, which worked until it created inflation. You could argue with COVID, they tried to cut the interest rates to drive up the house prices, which they did, to try and do it. But ultimately, the inflation came and they had to drive up the interest rates. There's a parallel there, surely.
Yes, absolutely. That's how the government, the Reserve Bank can respond to economic crises, is lowering interest rates. And a big transmission mechanism of interest rates is through home prices. We saw that in the 80s and early 90s, and we saw that throughout the COVID recession.
But we should also remember one other little thing. There wasn't actually an official cash rate like we get on the first Tuesday of every month. That didn't actually start until 1990. Before then, they relied on controlling the so-called overnight cash rate. That was, again, a little different to what we have today.
Yeah, but the fundamental idea was the same. It was making money cheaper, encouraging people to borrow, encouraging people to spend, get the economy moving again. So monetary policy has changed in how it operates, but the fundamentals are still the same.
OK, so you mentioned the employment story because that is the key right now. Number one, there is the record participation in the workforce. There is record female participation in the workforce. And yet we still have the unemployment rate in Australia very, very close to 48-year lows. Back then, ultimately, unemployment soared. And that was a thing that really cruelled, as I said, the home prices and really meant that people had nowhere to go when they'd lost a job and couldn't pay those very high interest rates.
So those big, sharp increases in interest rates in the 90s, which is what people are worried about now, started this vicious cycle where people lost their jobs as the economy contracted. They couldn't repay their mortgages. Arrears rates spiked, got close to 2% for households. That meant that more people lost their jobs and so on. And this cycle continued. And we ended up with home prices falling. We ended up with unemployment rates of 11%, a real proper classic recession.
And then also even the question about whether banks were safe. Westpac, of course, being a classic of those that went very close to the brink at that time. OK, so today, the difference here is if a person were to lose their job tomorrow, chances are they're going to find another job the following day or within the next month, at least anyway. Then it was a situation where there were no jobs for many people. And that's the reason why that unemployment rate soared and why the rate of default in the home lending market really went through the roof.
Yeah, exactly. I think the research has shown that the big thing that matters for people repaying their mortgages is whether they have a job or not. We've seen expenses for households increase a lot with mortgage rates, but people can plan for that. And they have been able to maintain paying their mortgages. The big thing is if unemployment starts to spike really sharply, and we haven't seen that yet, quite the opposite, that will be the thing that maybe is a signal that the housing market will decrease.
OK, so I mentioned the other thing that's changed is female participation in the workforce. And we know that in many capital cities, we've talked about this before, that you almost need two incomes to be able to support the size of the mortgages in capital cities these days. If we don't see a family lose two jobs but one job, does that make a material difference to their outcomes?
I think it does. I think a lot of people are relying on both of those incomes to service mortgages, particularly in the major capitals. But there's more flexibility in the workforce at the moment. There's more people able to work remotely, more people able to work part-time. There's more things like Uber, where people can work, just to fill in the gaps for employment and income. So I think households are in better shape now. And obviously, the state of the labour market is the biggest thing that households have going for them at the moment.
So the trick here is to keep your eye on the employment market if you're trying to keep a little bit of an eye on the housing market. Second factor also is that the housing market is very tight at the moment. There's more population coming in, the housing market's tight. So if you're actually set in the housing market, chances are that you're going to get at some point some uptick in the capital value of those houses.
That's what we're seeing at the moment. We're seeing home prices increase the last 5 months, despite these big increases in interest rates. I think there's been such a real strength in housing demand. Part of that has been, as you say, immigration, but part of it's also been how households have changed through the COVID recession. So the recession and the pandemic set us up for kind of fewer houses than we would have had. Households want bigger homes and smaller households. So demand is just really strong, and that's been supporting capital values over this year. And
long may it continue, let's say it that way, because we don't want to really go back to those days as well. Paul Ryan, always good to chat to you. Many thanks for your time today.
Thank you very much.